Is the resulting stock market volatility a signal to exercise an abundance of caution, or does it represent the darkness before the dawn, signaling possible investment opportunities? Does the current slow growth climate necessarily translate into stagnant investment returns? How should savvy investors be positioning their portfolios today? Hello, my name is Attorney Ramsey Barawi, and welcome to Your Money, Your Life. In this segment, we will discuss the current state of the economy and investments that may hold up well in this economic environment. To assist me in this discussion, I've invited Michael Pansavoy of North Amway Trust Corp. To join me. Mike, it's great to have you on the program. Welcome back.
Thank you, Ramsey. Nice to be here.
Okay. Economic recovery has been tepid.
Right.
And however, we've seen that the markets, in fact, had seemed to stabilize for a period of time. And then last week there was an announcement by the Fed, and the markets seemed to react negatively to that. Was the Fed worried about something, and why did the markets react in the fashion that it did?
It appears that the markets were expecting the Fed to implement another wave of stimulus, what was referred to as QE3. And what the Fed did announce is they will sell the short end of the curve and buy the long end of the curve, and the markets deemed it as a Operation Twist.
As I understand the announcement, you alluded to this, that the Fed will be taking money out of the short-term treasuries and it'll be putting them into the long-term treasuries.
Yes.
Okay. Doesn't that, in fact, however, damage the banks? Don't the banks rely on the returns they can get on the long end of the spectrum?
Well, in a way, what it would do, and what the Fed is trying to accomplish, is to lower the long-term interest rates.
So the Fed's announcement that it was going to be moving money into the long-term treasuries, the 30-year treasuries, as you mentioned, is that an attempt to stimulate mortgage lending? Is that what they're trying to do?
It appeared they attempted to stimulate mortgage refinancing.
Refinancing.
Yes.
Okay. In its announcement, and I'm quoting this, the Fed stated there are significant downside risks to the economic outlook. Did that spook a lot of people?
That scared people, because when the Fed is in their attempt to be transparent, and it appears that's what they're saying, they must be seeing something that worries them quite a bit, and they can't say it any other way. And so if the Fed is concerned, then everybody else is really concerned. That was the reaction.
When the Fed makes reference to significant risks, do you think they're talking about issues outside the U.S. economy, like the European sovereign debt crisis? Is that what they were referring to?
I think they were referring to that as well, because the European debt crisis is sort of threatening a lot of currencies around the world. The euro itself is declining. The Fed is trying to keep the dollar at a certain level versus other currencies to keep the U.S. economy in a competitive position. So the European situation plus our own together creates a worldwide situation where the economy isn't quite moving perhaps in the right direction.
Do you think, and I'm just asking for an opinion here now, do you think that by making the statement that there are continued risks, do you think the Fed was perhaps trying to give itself some wiggle room and basically say, you know, we can always change our statement next time around if the economy somehow improves? Were they perhaps trying to manage expectations, lower investors' expectations, and say, well, we think there are challenges out there and there are risks out there? They can always change that opinion, can't they?
Well, they of course can change their opinion. I think it would be somewhat counterproductive.
And the reason I asked that question is because it seems to me that there are times when the Fed is actually trying to manage expectations.
It is one of their techniques in making the market behave a certain way, of course. However, this time around it appears there is a pattern to their transparent speak, and it went from a soft patch to much more significant concern.
Okay.
And if they will change their mind quickly again, they may lose credibility.
Now, it's my understanding that the Fed has also alluded to the fact that we may be looking at low interest rates for the next couple of years. And they usually don't do that, do they? They usually don't give a defined period of time.
Right. Over the last couple of sessions, they defined that. Previously, they would say for the foreseeable future, and leave themselves room to make changes. Clearly, they are seeing that going out 2 years, as they announced, there will be no change on their part.
Okay. Now, by the Fed, as you mentioned, taking money out of the short-term U.S. Treasuries and moving them into the long-term Treasuries, they're basically doing what's called flattening the yield curve. Can you explain what that is and why is it important to flatten the yield curve?
Yeah, it's a good question. However, when the long-term rates come down and the short terms either stay the same or move up slightly, it levels the curve. And the economists call it a flattening yield curve. When the yield curve flattens, it usually indicates an economic slowdown.
When you look at historical comparisons between what's going on in our economy today, can we at all compare this low growth, low interest environment to what happened in Japan, or is that not a good comparison? Or are we in better shape than Japan?
Well, it's a good question. I think there are some parallels. Perhaps U.S. is in a better position economically than Japan is. It is what people call a lost decade.
Right, I've heard that used before, the lost decade.
So
It's like
there
10
is a
years that
parallel
just
someplace.
Did nothing.
Right,
Yeah.
right. And that's, again, a concern.
Now let's talk a little about the European sovereign debt crisis. Why is it that a lot of people are now concerned that the European Union may actually no longer be viable? And what's that all about?
Unfortunately, not every member is as productive and economically viable as some. For example, Germany in the EU is considered to be the most productive country and appears to carry the weight for many other less productive countries in the Union. People wondered why Germans were so strict in their approach, and that worried everyone again, and that's how this whole process started and came to light. So others speculated that EU may even fall apart, or maybe their currency will go away, etc.
Isn't one of the major problems with regard to the European Union the fact that there is no centralized authority to make
Right.
any decision? It's all decentralized. It all goes back to the governments within each individual country. And isn't that a problem?
I think it is a problem. I think many people don't realize, just as you said, there is no centralized financial authority. European Union is only about the common currency. At this point, there is nothing else in common. They have separate borders, they have separate government, separate financial governors, and so on. And the currency is the only thing they have in common. Mm-hmm. And so when economically one country doesn't do well, yet they use the same currency that is backed by another, a stronger economy, it creates a problem for the stronger economy. And that's what Germany, for example, for instance, was worried that they didn't want to lose their AAA rating as an economy, and they didn't want to be dragged down by a weaker country because they're not unlimited in resources either.
But as far as being a member of that European Union, yeah, if there's a problem with regard to Greece, that could affect the entire Union. And I think that's what we're looking at here.
Well,
as a smaller player as it is, right?
It is, and the contagion is the word again that people use. It could spill from Greece to Italy, perhaps Portugal, Spain, Ireland. We're looking at several countries that, for whatever reason, not doing well economically right now. It's not just Greece. And if we can backtrack to the crisis of 2008, it started with the problem in Iceland.
So if these problems in Europe deepen, I mean, there's been talk about Spain and Ireland and Italy. So if these problems deepen and involve more countries, isn't that going to create more uncertainty with regards to the European Union and affect the global economy even more so?
It could. It appears that the European Union is attempting to create what is called a Eurozone bond. And perhaps that will allow them to leverage the current financial situation and allocate funds to the problem areas so they don't have to be destructive and bring everyone else down, and allow refinancing of certain debts, perhaps imposing certain austerity measures to areas where it is required, and find a solution to this. But again, it's early stages of discussion, and the markets are being very sensitive to how quickly and how effective these measures can be. They're trying to find a way where they can take current debt and refinance it with new debt and find a way to reduce perhaps interest.
Let's talk a little bit about the United States.
All right.
We've had this in the past, it's been my view anyway, in the past that it's been procedurally pretty straightforward when the federal government's decided that, we need to take a vote in Congress with regards to increasing our debt ceiling. Well, of the last couple of months, this has become a major political battle, and the markets have not reacted well to this, have they?
Right.
And then in response to that, the S&P ended up reducing the credit rating of U.S. Treasuries.
Right.
What's going on? What political problems are we having here?
It appears that we're in a political divided environment, and we have two parties that can't come together and do what is good for the country. To me, it's a mistake, because in the past, whatever the differences among the political parties, they were able at least to come together and see that whatever they have to do is for the good of the country, not for the good of their own party.
My view is I think the markets also don't like the fact that not only is there this uncertainty with regards to what's happening on Capitol Hill in Washington, but there's also the sense that there'll be less government spending, and government spending has been a big part of the GDP. So if there's less government spending, that's a problem, isn't it?
It is. In fact, to draw on a previous parallel, in Japan, there was a reduction in government spending at the time when the economy was just about to turn the point, and it took Japan into the second wave of the recessionary process, and I think we could face something similar.
We have now a consumer-oriented economy. We have high levels of unemployment. We have a government that can't seem to agree on how it's going to take care of the debt ceiling. We have a slow growth economy. I mean, we've got a lot of negativity here.
We do. We have a high unemployment rate, and all this action by our politicians also reduce the consumer confidence.
Exactly.
And that does not lead to better economy anytime.
It's clear we have some serious issues. Now let's talk about what investors should do in this environment. Let's start with the low interest rates. If someone is near or in retirement and they're trying to take their retirement money and develop an income stream, a livable income stream, when interest rates are so low.
It is a problematic environment right now for this sort of a situation. Interest rates are extremely low, and if you're a conservative investor, you are hard-pressed to find anything you can do to rely on income for a reasonably long period of time. I'm talking about maybe 3, 5, 10 years down the road to know you'll be getting that interest, and enough of interest to pay your bills. Mm-hmm. It is very problematic, and I think people need to explore other areas, but other areas such as municipal bonds or dividend-paying stocks also carry risk.
Right.
If a stock goes down by 5%, all of a sudden they cancel the dividend you were receiving that could be in the area of 5%. Municipal bonds get a lot of negative press lately, whether it will come to fruition or not. Mm-hmm. They do pay more than the treasuries right now, but there could be risks that are hidden. Municipals are much more difficult to analyze for an everyday individual, and so I think overall investors need to exercise a lot of caution.
With regard to investor behavior, it's my impression that investors like safety.
Right.
There are a lot of concerns, there's a lot of uncertainty, this is not a safe time. And unfortunately, investors will react emotionally in times like this, which I will just throw the question out to you. Should they be reacting emotionally? And if not, what can they do to remove the emotion from the equation?
I think it is human nature to be emotional about important things. And even though some say you have to be disciplined in your approach to investing, people still feel emotional about it. And it is important to understand when you invest, you need to be comfortable with what you're doing. You need to understand what you're doing. And in order to get control over the investment process, you have to educate yourself. And if, let's say, someone is not up to doing it themselves, they need to talk to a financial advisor who has experience in creating an income stream, creating a portfolio that they can understand and be comfortable with. And that will eliminate a lot of stress, and emotions will be in the right place versus simply saying, I have no idea what's going on.
Well, at one point we had something called irrational exuberance. I don't think we need irrational pessimism.
You're right.
Okay, I think it's a good place for us to stop. The current economic recovery has been tepid at best. Indeed, the persistently high levels of unemployment, coupled with a still troubled housing market, European sovereign debt crisis, and gloomy economic reports all point to the fact that we're experiencing a low or perhaps even a no-growth environment, one fraught with ongoing tension and weakness. Add to these concerns a low interest rate environment which makes generating investment income quite challenging, a challenge that Mike Pansafoy explains is likely to be with us for some time. Can we count on the U.S. and global economy returning to historical levels of gross domestic product growth anytime soon? I think the stock market volatility seems to be signaling not so fast. I think we need to come to grips with the fact that we live in uncertain economic and political times, and uncertainties will continue to lie ahead. So don't panic. Rather, put in place a plan that allows your investments to remain balanced and diversified. As Mike Pansafoy opined, while there are no magic bullets for protecting your assets in this less than sanguine economic environment, investors can discover pockets of opportunity. However, before you invest, make sure to exercise due diligence. For as Ben Franklin is quoted as saying, an investment in knowledge always pays the best interest. My name is Attorney Ramsey Barawi, building your trust.